This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, May 25th, 2016. I'm Gord Long at GordonTLong.com. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I'll pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing in some of the charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research document this month updates Global Macro. Therefore, the slides this morning will focus on the other three report areas of the GMTP report: global risk, regional, and U.S. economic developments. As I often do, I'd like to tie them together into a further discussion on the suspected Shanghai Accord, which has been happening since it was struck in late February, and the repercussions of the recent G7 meeting in Sendai, Japan. In this regard, I'd like to go through the following subject areas listed here. We have discussed the Shanghai Accord in a number of previous reports. The results have left us with little doubt that whether implicitly or explicitly, some sort of understanding was reached at the G20 Shanghai meeting in late February between country finance ministers and the central banks that were all in attendance, including IMF. Like any agreement, there is give and take with the expectations that all members are better served with the accord. What is obvious is that the agreement was not a winner for Chairperson Janet Yellen. Her body language there was obvious. She had been forced to accept something very painful, like a student being handed a paper with an F on it. Her demeanor spoke volumes without someone actually knowing the results of the score. What Janet had to deliver was a weakened U.S. dollar, which meant no rate increases that she had been signaling for some time, least of all the four she had been signaling since assuming full control of the reins of the Federal Reserve. A strong dollar was crippling global trade and accelerating an already slowing global economy. All G20 participants knew the U.S. dollar had to be taken down, and the U.S. had to take actions needed to stop its ascent. Global liquidity was rapidly drying up, and further massive central bank balance sheet expansions were not politically palpable, especially as politicians ballyhooed the recovery underway. Though the U.S. deficit is still large, it has been cut significantly, which has a major impact on global growth, as we've discussed previously with regard to the Triffin paradox. Nevertheless, Janet accepted her role, and with equally troubled Bank of Japan Governor Kuroda and ECB's Mario Draghi, they departed to implement the agreement. Japan's Governor Kuroda had to push the yen up, absolutely 100% against expectations and the requirement for a stalled Japanese economy. His March 7th meeting shocked the markets and began achieving the rise required in the yen. Likewise, the yen increased in value relative to the Chinese yuan. As we've discussed in previous reports, a prime mover of the accord was China, threatening a weaker yuan, but willing to accept the current yuan value if other currencies rose against it, thereby effectively weakening it on a relative basis. And that was the key. Mario Draghi likewise shocked the markets right after that on March the 10th, when he started the euro on a rising trajectory, also despite poor economic conditions and not what the analysts were expecting. Like Japan, the reversal was achieved by expectation setting as opposed to specific policies. Similarly, the euro rose against the Chinese yuan as had been planned. Meanwhile, the political situation in the U.S. was heating up in the March timeframe and April, with the U.S. presidential primaries taking unprecedented focus. Historic turnouts and the rise of non-establishment candidates like Donald Trump and Bernie Sanders sent quakes through the halls of Washington. This was not the time for a possible perceived weakening of the great recovery that was underway. Signs of a recession were everywhere. I have shown over 50 charts of this in previous reports. There's little question the U.S. has got a recession on the horizon, if we're not already in it now. But nowhere is this to be seen anywhere in the public media. A U.S. recession scare going into the presidential election was simply unacceptable. I am sure this was all a concern when Janet Yellen was summoned to the White House, while in parallel she summoned an emergency special meeting of the FOMC following that meeting. Also on the White House agenda was likely a discussion of not derailing the European Transatlantic Trade and Investment Partnership Agreement, as well as the June Brexit referendum vote. A weakening economy was simply out of the question. I am sure this was a very difficult meeting for Janet, as she explained why she was going to be forced to increase interest rates. I think that there was an agreement struck at this meeting, or an understanding that just couldn't be the case, and a strategy was implemented. And we'll see how critical that meeting was here in a moment. There were some outs, though, for her. And her advisors, I'm sure, worked the strategy very, very carefully. One was to deflect the heat to Japan. Likely, as a consequence, Japan was suddenly charged as a currency manipulator just prior to the G7 meeting in Sendai, Japan, which became a major part of that discussion because Japan was arguing that it wanted to stop the increase in the yen value as destroying the economy or hurting the economy, and clearly Janet wanted them to continue increasing the value of the yen. The other was clearly to deflect the major shift in policy to China. If you look at the charts, right at the time of this meeting, on April of the 11th and 12th, the U.S. dollar against the Chinese yuan suddenly reversed dramatically and started rising. Something happened. This sent signals to China. China clearly saw that. And as you can see here in this chart, the already tense situation got even tenser. A little later, when on May the 2nd, Chinese devalued the yuan because they could see that it broke this channel showing on this chart and was rising, and they tried to bring it back in line, but it couldn't. They couldn't overpower it. The yuan had been falling against the U.S. dollar as planned, but was showing signs of breaking here. The Chinese weren't taking any chances and devalued. They again devalued on May the 17th and May the 24th, when it was clear the accord was no longer working and that they were actually fighting the U.S. in some manner. They just simply weren't successful with these small-scale actions. To the Chinese, the whole accord was simply too little too late. Their August 2015 devaluation made the Shanghai Accord appear as a minor blip. It was also starting to leak that the Chinese had changed the policy regarding the yuan market pricing mechanism versus government control, which apparently they had taken this stand in January. The Wall Street Journal leaked the news in May, but Yellen was obviously well aware of this and knew the Chinese were willing to use it. She had a gun to her head, and the Chinese were firing these warning salvos, and she knew that they would be forced to make a major devaluation. They would be the fall guys. As in August, markets would probably fall, be turmoil, and Japan and China would be blamed. In parallel with all this, the Chinese were very upset that the Fed was now taking such a hawkish stand suddenly towards a rate increase, which they hadn't been prior to the April 16th White House meeting, and were strongly talking it up. This was putting upward pressure, as you would expect, on the U.S. dollar. The U.S. was effectively bolting from the accord at that point. New York Fed Chairman William Dudley's presentation on May 19th was too much. The Chinese fired their second salvo on May the 17th and then followed it on May the 24th. The Chinese just couldn't wait any longer, and the Fed knew it. Either the Fed played ball or they would take the ball, and that's the game that Yellen was playing. She was expecting that the Chinese would take the bait and would be the fall guy for what she had to do all along. Global trade was slowing even more rapidly, and the boat anchored off the coast of Singapore was reminiscent to me of 2007. Though a lot of ships this time were simply floating oil storage facilities playing the contango game, there were still a lot of empty cargo containers, reflecting the slowdown in global trade. Additionally, and maybe even more significantly, a big part of the Chinese GDP is capital formation. Though it has massive exports, it also has massive imports, and they don't quite net out, but the dominant factor in the Chinese GDP is capital formation, and when it's negative and flowing out, it is a major problem if you need to be growing your GDP, especially when you need the capital to investment capital. The way to do that is to lower your currency, which will attract capital into the country and make things more attractive from a financing standpoint. Additionally, they knew they had to increase credit in a large fashion to sustain an already imploding economy. Don't forget that the Chinese and Japanese have never been friends and are fierce competitors when it comes to each other. For Japan to give so much currency advantage to China was simply intolerable. Never mind the economic impact it was having. Something had to give, and Japan was making it clear during this period that it was not going to allow the yen to increase in, quote, a disorderly fashion. Suddenly a war of words between the U.S. and Japan was erupting on what was considered orderly and what was disorderly. Going into that G7 Sendai meeting, the lines were clearly drawn in the discussions that would ensue. Global trade in Japan had also collapsed. Exports were down, imports were down, and were getting worse. The results was an unexpected rise of Japan's trade surplus, yet another apparent political failure of Abenomics. Japan had its back to the wall and likely would also bolt at some manner in here. Out of all of this and the FOMC minutes that came out, the markets violently repriced June rate hikes from 4 to 30% and in July from 20 to 50%. Deutsche Bank was writing feverishly that the market is not ready for June hikes, with a series of notes spelling out the magnitude if Janet was to go ahead with these increases. And this is why Deutsche Bank thinks that just like in July, August, and January, February, as the market starts to earnestly price in a June-July rate hike, everything is about to plunge once more. It is my sense that really what we're going to see is that the rate hike will be pushed off, probably not happen, or some kind of agreement struck to bring it out in July. Let me quote what Deutsche Bank spelled out in one of its recent notes. Quote, "We think the answer is no because the issue is not just the timing of a single hike towards some static goal for rate level in 2017. What is at issue is the existence of some Shanghai Accord whereby global policymakers have agreed explicitly or implicitly that excessive dollar strength is counterproductive and that policymakers should shift their focus to domestic demand and structural reform within an environment of dollar stability at least through the next G20 in early autumn. If there is no accord, then divergent monetary policy could drive the dollar stronger, restarting, among other things, speculation against the Chinese yuan versus the dollar rather than the Chinese yuan versus the entire basket, with now very similar results. Reserve loss exacerbating higher Fed expectations for U.S. rates and downward pressure on risk assets with a non-trivial chance that China might devalue and, worse yet, do so in a lumpy fashion. As many are speculating, it will all be up to China again to stop the Fed's rate hike. And this is, as we've said earlier, is what Janet is expecting. Janet Yellen knows the only way out is to let the U.S. market correct, blame China and Japan for currency manipulation, causing the market turmoil like Japan did in August 2015, then ride to the market rescue with more stimulus as the U.S. election neared. Obama's recovery had only temporarily been impacted as a consequence. A major gamble, but little choice. Clearly, a U.S. recession was near at hand, and the Fed can see that. The timing of all this plays very well, especially when we have the U.S.-Chinese meeting of the U.S.-China Strategic and Economic Dialogue set for June 6th and 7th, where China is already signaling it wants to understand Fed's upcoming policy priorities. I mentioned a recession. The yield curves are sending very clear signals. The 530s suggested one of two things. Either economic activity is projected to slow in the next 9 months, or the ECB and Bank of Japan have turned the entire globe into a bond bubble based on relative value, which infers that every asset in the world is mispriced. The answer, actually, according to Ira Harris, may be a mixture of both. So Yellen really has no choice but to play this game. China, however, is far from and can be counted on to play a new card at the special U.S.-China Strategic and Economic Dialogue on June the 6th. The markets read the tea leaves right after the G7 Sendai Dischord. Japan would temporarily play along a little longer and leave an impatient China as the sole bad guy. The situation in China left the Chinese with little choice and time, and why we saw 3 yuan devaluations, as I said earlier, on May 2nd, the 17th, and the 24th, all leading up to this June 6th meeting. 3 years ago, I predicted an M-top, where the inside strength of the M would be reversed due to unprecedented central bank policies, which would trigger the beginning of a potential Minsky melt-up. I ask you, what would happen to stocks if the Federal Reserve said it was going to start buying equities like the Bank of Japan has done with the Nikkei and other central banks are doing? Sounds ridiculous, but if we have a significant market correction, these are the kinds of actions that would take the market and skyrocket it up, which would be a wonderful thing to have going into the elections if you were the Democratic Party in control of the government. It is reported that governments and their central banks have already purchased over $29 trillion in public assets around the world. Would that cause a melt-up? At least temporarily, while the currency used to purchase the assets is perceived to be of some value. We're getting close to all of that. Whether it's helicopter money, collateral guarantees, we're going to be shocked at what the central banks are going to come out with, including, again, as my friend Ira Harris is suggesting, that he believes that the real accord is going to be a global strategy of fiscal stimulus. And that may be the big announcement, and we've always believed it was coming in regards to infrastructure. But it may be post-election versus pre-election, and we have a crisis before this election. In closing, remember this. They will always print more money. It's the only answer politicians can ever agree on. So if you know that, invest accordingly. In closing, I'd like to take a moment as a reminder. Do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom actually been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a very knowledgeable and well-informed financial advisor. So until we talk again, may 2016 turn out to be an outstanding investment year for you and your family. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.